In recent years, there's been diversity in practice in the accounting for the measurement of financial assets and liabilities of CFEs. To address this diversity, the Eitf has been working to address this issue over the past several meetings. Hello everyone, my name is Jack Pullman and I'm a Senior Manager in KPMG's Department of Professional Practice. Welcome to KPMG's podcast on Eitf Issue 12G, which relates to the measurement of financial assets and financial liabilities of consolidated collateralized financing entities, which we will refer to as CFEs. At its November 14th meeting, the Eitf met to discuss the revised consensus for exposure that was issued previously in June. We can summarize the background of this issue and the key points of the Eitf's discussion on the next few slides. At its meeting on November 14th, the Eitf reached a final consensus on this issue. So let's just touch upon a brief background on this issue. A collateralized financing entity, or a CFE, is an entity that holds financial assets, such as asset-backed securities, and issues beneficial interest to investors. These beneficial interests are usually debt instruments that are considered financial liabilities under U.S. GAAP. And because the CFE generally has little or no equity, it typically is a variable interest entity under U.S. GAAP and subject to the consolidation requirements that apply to entities not controlled through voting equity interests. Consequently, an entity may be the primary beneficiary of, and therefore required to consolidate a CFE for which it is the asset manager, even if it owns no equity or beneficial interest in the CFE. An asset manager may be the primary beneficiary of a CFE that is a VIE because it has the power to direct the activities that most significantly affect the CFE's economic performance by making decisions about the CFE's investment portfolio. An asset manager also may have the right to receive benefits that could potentially be significant to the CFE through a subordinated management fee. Many reporting entities that are required to consolidate a CFE elect the fair value option for all of the CFE's eligible financial assets and financial liabilities. Although a CFE's assets are the sole source of repayment for its beneficial interests, and its beneficial interests are entitled to receive all of the cash flows from the CFE's assets after payment of management fees and other expenses, there are fair value differences between the CFE's assets and its beneficial interests. And those differences may be caused by different liquidity discounts and duration mismatches between the assets and the liabilities. As a result, there's diversity in the accounting for these differences between the fair value of the consolidated CFE's assets and liabilities. Some primary beneficiaries record the initial difference in fair value as a gain or loss in the consolidated income statement. Other primary beneficiaries do not recognize a gain or loss in the consolidated income statement, but instead record it directly to appropriated retained earnings. So in the final consensus, the task force reached an agreement to measure the assets or liabilities based on the more observable of the assets or liabilities. So what does this mean? For example, if a reporting entity determines the assets have a more observable fair value, then the value of the liabilities would be measured based on the fair value of the assets. Similarly, if an entity determines that the liabilities have a more observable fair value, then the value of the assets would be measured based on the value of the liabilities. The assets and liabilities would be presented gross in the financial statements, and the non-financial assets would be measured based on the other applicable U.S. GAAP. The measurement would exclude interests that represent compensation for services. An important point to note here is that the fair value of the beneficial interest held is measured separately, even if the fair value of the assets may be considered to be more observable. And we'll touch on this in the next few slides as well. The final consensus would include a requirement to apply the measurement upon initial consolidation for CFEs. Entities that choose not to apply this as a subsequent measurement would account for the assets and liabilities of the CFE based on other topics in U.S. GAAP, but would not be permitted to apply the fair value option. If the approach is applied, the fair value disclosure requirements would apply to the more observable of the assets and the liabilities, and the fair value of the beneficial interest owned by the reporting entity would also need to be disclosed. For public entities, the standard will be effective for interim and annual periods beginning after December 15, 2014. And for private companies, the standard will be effective for annual periods beginning after December 15th, 2015, and interim periods thereafter. The guidance would be applied using a modified retrospective method. This slide highlights a few other key discussion points that we observed during the meeting. It was observed through the comment letter process that various comment letters highlighted that previously issued exposure draft would potentially distort the net income of the reporting entity as a result of measuring the beneficial interest owned using the allocated value. And because of this, the task force agreed to measure the beneficial interest owned at fair value separate from the allocation, even if the assets are considered to be more observable. The objective for this is to have the income statement reflect the changes in the fair value of the beneficial interest owned. The fair value option would not be permitted because of the measurement differences that arise when applying the fair value option to the assets and liabilities of the CFE. This was one of the primary causes for the diversity in practice historically. So let's go through an example. Let's assume that entity A consolidated a CFE that previously applied the fair value option for all CFE's eligible financial assets and liabilities. Let's assume that entity A consolidated the CFE that previously applied the fair value option for all of the CFE's eligible financial assets and liabilities. And let's also assume the following. The financial assets are loans with a fair value of 105 at June 30th and 110 at December 31st. The non-financial assets have a carrying value of 5 at both June 30th and December 31st. The financial liabilities are determined to be more observable with a fair value of 90 and 95 at June 30th and December 31st respectively. And the fair value of the beneficial interest owned is 16 at June 30th and is 20 at December 31st. By using the approach agreed upon in the final consensus, we would first determine if the financial assets or the financial liabilities are more observable. As noted on the previous slide, we're assuming that the financial liabilities are more observable in this scenario. This may be the more common situation, but there could also be other cases where the assets are determined to be more observable. At initial consolidation, an entity would take the fair value of the financial liabilities of 90 and add the separately determined fair value of the beneficial interest owned of 16 to get a total value of the financial liabilities of 106. The entity would then deduct the carrying value of the non-financial assets of 5 and allocate the remaining value to the financial assets. This would leave us with net assets of the CFE of 16 as of June 30th, which also reflects the fair value of the beneficial interest owned. The entity would follow a similar approach at December 31st, and for our purpose here is to show you that the change in fair value of the beneficial interest held from 16 at June 30th to 20 at December 31st would be reported in net income. It's important to note here that if we were to assume a different scenario with the financial assets being more observable, the reporting entity would then use the fair value of the financial assets, back out the fair value of the beneficial interest owned, and then allocate whatever is left to the other financial liabilities, apart from the beneficial interest owned. This was the objective of the task force, so that the change in the fair value of the beneficial interest are recorded through the income statement. So hopefully that provides a good recap of issue 12G. Just as a summary, the financial assets and financial liabilities would be measured based on the more observable of the financial assets and liabilities. The second key point to remember is that the fair value of the beneficial interest owned would be separately valued apart from any allocation of the financial assets or liabilities. And then lastly, the effective date for this proposal is for interim and annual periods beginning after December 15th, 2014 for public companies. And then for private companies, this would be effective for annual periods beginning after December 15th, 2015 and interim periods thereafter. Entities would apply a modified retrospective method for all existing arrangements to reflect this model at initial recognition. And then a policy election would be made as to whether to apply this model to subsequent measurements. That concludes KPMG's podcast on measuring the financial assets and financial liabilities of a consolidated collateralized financing entity. You can find more information on KPMG's Financial Reporting Network website on this matter. Thank you for listening to me today on this podcast.